All right, let's get right into it. Oil prices are spiking, markets are getting shaky, and you can just feel that predictable panic setting in. But what if I told you that the data from the last 50 years shows us that most investors are about to make the exact same mistake? They always do. We're going to break down that pattern right now.
And yeah, that quote really gets to the heart of what we're talking about today. See, this isn't just a gut feeling, it's a historical pattern. It's a repeated, almost knee jerk reaction to crisis that, according to the data, has been the wrong long term move 5 out of the last 5 times.
Of course, the fear is totally real. I mean, when you see gas prices jump by nearly a buck a gallon in a single week, it feels like the world is shifting under your feet. It's an immediate punch to the wallet, and that's exactly what drives the panic we're seeing in the markets. So let's start right there with that panic. What is happening right now that has Wall Street so spooked? And more importantly, where is all the money going? Well, here's the problem in a nutshell. We're not talking about some minor disruption here. The Strait of Hormuz is one of the most critical choke points for global energy. And when 20% of the entire world's oil supply is basically stuck, you can see why the market is reacting so strongly. And this shows you exactly what happens next. It's what they call the consensus trade. Money is just flooding out of growth sectors, tech and consumer stocks, and it's piling into what people see as safe havens, energy, gold, and defense. The S&P energy segment alone is up 24% year to date. It seems like everyone is buying oil and selling literally everything else. But here's the thing, we have seen this movie before. So let's step back from the immediate panic and look at the historical data, because it shows us how this exact pattern has played out over the last 5 decades. Just look at this timeline. You've got the OPEC embargo in 73, the Iranian Revolution in 79, the Gulf War in 90, that crazy speculative spike in 2008, and the Ukraine invasion in 2022. Every single one of these events was different, sure, but they all kicked off the same initial reaction, a massive, fear-driven spike in the price of oil. And here is the punchline. Every single time, without exception, that spike reversed. After 1979, oil crashed 40% by the mid-80s. In 2008, it collapsed a full 80% in just 5 months. The reactionary trade, buying energy at the absolute peak of fear, got completely hammered on the way down every single time. Now, look, I know what you're probably thinking. It's easy to just say, don't worry, it always works out. We have to ask the tough question, is this time really different? So let's look at the skeptics case, because there are some legitimate reasons why this crisis feels more dangerous. And this right here is Exhibit A for the skeptics. The closest comparison we have is that Iranian crisis back in '79, which took about 7% of the world's oil supply offline. Today, the Strait of Hormuz situation is holding up 20%. The scale of this physical disruption is way, way larger. And there are other things making investors nervous too. For one, the U.S. Strategic Petroleum Reserve is only about 58% full. And while OPEC claims it has spare capacity, most of that is in places like Saudi Arabia and the UAE, meaning it has to get through that same blocked strait. So right now, that spare capacity pretty much only exists on paper. So yeah, on the surface, it looks pretty scary. But there is one critical piece of data that changes the entire calculation. It's like our economy has this hidden shock absorber that just didn't exist back in 1979. This right here might be the single most important chart of this whole explainer. Back in 1979, oil made up 1.5% of America's GDP. Today, it's just 0.4%. An oil price shock simply doesn't hit the economy with anywhere near the same force that it used to. I mean, that is a staggering 70% reduction in our economy's dependence on oil. And why is that? Well, think about it. Cars are way more efficient. We use natural gas for heating. Renewables are a much bigger part of the mix. And of course, the rise of remote work means a lot less commuting. The odds of a full-blown oil-driven recession are just so much lower today. So if chasing the oil spike is the big historical mistake, then what does the data suggest is the smart move? Let's talk about the playbook for how to navigate this window of opportunity. This is really the question every investor should be asking themselves right now. If everybody else is zigging into energy stocks, where should you be zagging? Well, history gives us a surprisingly clear answer. You see, the playbook is pretty simple, and it has repeated itself over and over again. Step 1, a crisis hits. Step 2, fear drives investors to dump growth stocks like tech and pile into energy.
But then, step 3, as the crisis fades, the energy stocks fall from their peaks, and all that money flows right back into tech, which then goes on to create durable, long-term wealth. And you know what? That window can be surprisingly short. The data shows that the average time for the S&P 500 to completely recover from a major geopolitical shock is just 42 days. That period of maximum fear is often really, really brief. So, how do you actually find those opportunities? Well, one super useful metric is something called the PEG ratio. To put it simply, it helps you see if you're paying a fair price for a company's growth. Think of it like a bang for your buck score. A PEG ratio under 1 is often a sign that a stock could be a real bargain. And what's wild is that right now, because of this fear-driven sell-off, you have a whole bunch of high-quality tech and AI companies trading at PEG ratios way below 1. I mean, these aren't speculative startups. These are companies with real revenue and real earnings that have been tossed aside simply because oil scared everybody away. And here's the kicker. There is a record $7.8 trillion in cash just sitting on the sidelines in money market funds. That is a mountain of dry powder, just waiting for a little bit of clarity. And when that money decides to move back into the market, it's not going to chase energy stocks at their peak. It's going to flow into quality growth stocks that are on sale.
In fact, even as we speak, we're seeing signs that this playbook is running once again. As we get some diplomatic signals that tensions could ease, oil has already started to drop hard, and stocks are bouncing back. We might just be watching that 6th historical reversal play out in real time.
So, at the end of the day, the choice is yours. In this short, critical window between peak fear and recovery, which is where wealth is so often created, are you going to follow the panicked crowd, or are you going to follow the data?